Hello and welcome to another daily dose of insights powered by Container Exchange. My name is Christian, and every other day we're bringing to you the key stories and data points that move container markets and your business. Something very interesting that I read yesterday was talking about the continued decrease in vessel utilization and its impact on freight rates. And of course, the two are correlated. So the lower vessel utilization is, the lower freight rates become, because carriers have an incentive to fill that space and are essentially negotiated down on their freight rates. This led to an increase in vessel layups, so setting vessels to idle, essentially container vessels being parked as they represent capacity that is not needed right now. Last week, 50 additional vessels were laid up, which brings the total to about 370 vessels with a total TEU capacity of 1.6 million TEU, around 6% of total global cellular container ship vessel capacity. While this is already pretty bad news, 2023 will also mark the beginning of a new build avalanche on the container vessel side. Container vessels that were ordered at the beginning or the first spikes of the pandemic, when freight rates really shot up, now come online, now hit the waters beginning in March, April. Container vessels unfortunately always take 2 to 3 years to be built, to be produced. So that's why there's this time lag between ordering and coming online. In total, the industry expects about 2.5 million TEU, new build TEU, to hit the waters. And if you compare that with the currently laid up vessel capacity of 1.6 million TEU, you see what magnitude is coming there. So round about 10% of global fleet will be will come in addition to what's already there. Impact on freight rates, of course, as to be expected. And also very interesting will be to observe the market for second-hand vessel tonnage. More vessels, more newer vessels, more efficient vessels typically mean a decrease in market prices of the existing second-hand container fleet. The second very interesting thing that I wanted to share is a little bit of a sneak peek of our insights data product. Essentially the trading price monitor that we have already online. We're constantly innovating and adjusting, and these are a couple of the additional analysis that will come online shortly. What are we looking at here? We're looking at 40-foot high cube cargo worthy containers and comparing these between Denver and Shanghai over the last roughly 14 months. The top left-hand graph is just the market price development. Gray is Denver, the blue is Shanghai. And already here you see very interestingly how this diverges sort of in July, August last year, with Shanghai cargo-worthy containers continuing their decrease, their slide, while Denver actually holds up quite well. Now, very interesting if you actually compare that to the global average container price. So this is an unweighted, just standard average container price. Shanghai is now, for the first time in a long time, in negative territory, so trades at a discount to the global container price average, while Denver actually is 80–90% above the global market average, so significant surplus or significant markup to the global market price. Now, of course, how this will play out in the future remains to be seen. We expect secondhand container prices to be significantly depressed in the latter half of 2023, just as more and more off-hires will push the availability of secondhand containers up. For new build containers, this remains to be seen. Also something very interesting, an interesting outcome of our webinar about SOC containers that we ran yesterday. Feel free to check out the recording online, where we also discussed the availability of new build containers ex-China, as production virtually slows almost to a standstill, with only roughly 700,000 TEUs expected to come online this year. These are steel boxes, so containers, not vessels. And lastly, something very interesting to observe when you look at these container market prices here as well is volatility. So volatility is measured in standard deviation around the mean over a certain period of time, and this is the 7-day volatility here. And you see that especially the Q4 2022 saw a significant spike in container price volatility, so a lot of uncertainty, a lot of sort of up and down movements on a daily basis on the price level, and this has come down significantly now to a level below what we had over the entire, almost the entire second half of 2022. Interpretation could be the market is unsure what's coming. Traders adopt a wait and see attitude, and that's also something that we discussed in our webinar yesterday. That liners and leasing companies also holding on to their equipment a little bit longer, especially if they have free storage agreements with depots, to wait and see how container prices will develop. Right, all of this will come online in our Insights product very, very soon. If you want to learn more about this, head to containerexchange.com/insights, or of course, hit me up with an email anytime. Happy to discuss. Cool, that's it for me for today and for the week. Thanks for tuning in. Hope this was useful and interesting for you. Have a successful rest of the day, and talk to you all on Monday. Take care.